G'day Internet, Max right here, and I've got a really fun video here. So this is a video called The Metaverse is the New Solar System, and it's a 2.5 hour conversation between Rauol Pal and Robert Breedlove. And it's basically Rauol laying out his macro framework that just controls all of his investing. For a little bit of background on Rauol, he was a Goldman Sachs macro guy. He's been in this industry for 30 years, surrounds himself with the brightest people, and has quite a brilliant macro understanding. Which, by the way, I consider myself a macro investor too. It's understanding a little bit of everything, understanding how everything sticks together, and watching for trends and changes and cycles and trying to predict the future. And the reason I do that is because it's just so much easier to invest when you're swimming with the current. If you can predict that there's going to be 1 billion users in Bitcoin in 5 years, that makes it really, really easy to invest, right? And so the two main jobs of a macro, I would suggest, is that's not quite a good way to say it, but a funny little thing about macro investing, which I kind of like to think about, is that whenever there's a trend, and there's trends all the time, some things you need to extrapolate and see where are things going. That would be productivity. Productivity is just going to get better and better and better and better, just go forever and ever. And then some things happen in cycles, and they yin and yang, and they up and down. And very often, if you extrapolate on, you're in the middle of a cycle and something is going up like this, and you go, I'll extrapolate. And just as you go to extrapolate, it turns around and rolls over and goes the other way. And so something interesting from a macro investor is understanding what is there to be extrapolated linearly, what is there to understand cycles, and then I'll throw another one in there, what is there to be extrapolated exponentially, like Metcalfe's law and network effects. So all those kinds of things come into playing and coming up with a tapestry for how society is going. And it's economic, and it's business, and it's social, and it's political, and it's all those things tie in to understand where the world's going to be. And if you understand where the world's going to be in 5, 10, 15 years, you can now get to swim with the current as an investor. You don't need to be the world's best Bitcoin trader if you know there's going to be 1 billion Bitcoin users in 2025 and 3 billion Bitcoin users in 2028. You just get to go and buy Bitcoin at the worst possible time, right before a big crash, and you'll still be a multimillionaire in a few years' time when you swim with the current as an investor. So that's why macro investing is so powerful. And that's what led me to Bitcoin in 2012, because I understood that. I just understood all of those things very, very well. So now, don't get me wrong, Rauol Pal has forgotten more than I'll ever know. He's a much better macroeconomist than me. I think I'm a little bit more conspiratorial than him, and maybe that helps me give up, lose faith. I don't say lose faith. I actually have more faith in I know what they're going to do, because I think I have a pretty good understanding of the conspiracy things going on in the background. Whereas I think maybe Rauol thinks maybe they're a little more good-natured than me and just screw it up a lot. And I think they have a little bit more of a plan to it, which maybe why that led me to Bitcoin a little bit earlier. So I wanted to share with you this clip, and it's a fantastic clip. I'll put the link in the, not the clip, the whole video, 2.5 hour conversation. I'll put the link in the description. I highly recommend you check it out. But I'm going to revisit this clip, I think, a few times over the next few videos with just some observations along the way. And I'm going to kick it off with something that I just slightly disagree with Rauol about. And so let's talk about it here. It's kind of like the history of where we are now, because in laying out his macro framework, he spends a good chunk of the time on history, understand where we're going, and brings up a few cycles, brings up a few concepts that are happening linearly, and weaves that tapestry to design the future projections. But I have a slightly different opinion with him on the future, so on the past, I beg your pardon, which will dictate where the future is. So let's just hear him lay out his argument first.
To these baby boomers. 1967, the first of them start entering the workforce. So they just hit their 20s and they start entering the workforce. Great. For the first of those guys, amazing. Then by 1975, the average baby boomer is now in the workforce. So you've got the highest increase in people in the workforce ever. And two things happen. Firstly, prices explode. Because if you think when you first got your first job, what do? You rent an apartment, or
Right.
you have to buy, in the old days, a suit and tie. You have to buy tables and chairs. You buy yourself a car. Your marginal rate of consumption explodes.
Yep.
When you're doing that on a global basis, it explodes beyond anybody's comprehension.
Right.
It's the largest demand shock the world had ever seen and will ever see. We will never repeat anything like that again. So obviously supply can't catch up with demand. So the oil price goes through the roof. All commodities go through the roof. Everything goes through the roof.
Right.
And so everybody's scrambling to catch up. America can't deal with running twin deficits and being pegged to gold. It's losing its gold supplies.
Yep.
Its currency's too strong. And in 1971, Nixon walks away from the whole thing.
Yep.
And we go to the fiat money system because it's unmanageable with this population boom going on and the rising inflation and all of the other pressures that are going on. By 1986, the baby boomers enter the workforce. The last baby boomer enters the workforce.
Mm-hmm.
So you've got this period, which we refer to as the Great Inflation, which most people think of as being a monetary phenomena. I think is a demographic phenomenon. I can prove it in every chart that I look at proves that it was demographics.
Right.
The monetary side, of course, played a role. But the reality was, if you were to put the same setup anywhere in the world, regardless of what you're pegged against, you've got the same demand shock.
Right.
And the world can't keep up. Right now, as we're talking, we've got a supply shock. So, the demand has risen to normal levels, but supply has massively contracted. So prices rise.
Mm-hmm.
That tends to be offset quite quickly because as things come on, the general level of prices stabilizes again. Sure, the price doesn't fall; it never goes back.
Mm-hmm.
But it kind of stabilizes. So the other part of that equation is not the inflation. The really big story is the one that nobody understands.
Okay, so I'll pause it there. He's about to talk about a second component. I'm going to play that section 2, and we'll talk about that. But let's just hold off there. So basically, he's saying that the whole massive inflation of the 60s and 70s, the stagflation period, all of that was a result of demographics and not monetary policy, or primarily demographics. He said, in his words, sure, the monetary policy played a role. Now, basically, I agree with pretty much everything. It's just getting into a little bit of the nuance here. But I think it's important because it kind of lends itself to, let's say we were on a Bitcoin standard and the governments weren't there to meddle with interest rates and meddle with supply. Would that whole process have been as bad as it was going to be? And to what degree would things have been better? And I hope by the end of this conversation, you'll see that it's going to significantly better. It was the meddling in the currency supply that massively amplified what was going on there. So let's understand a little bit about what's going on there. As you correctly said, this baby boomer generation enters the workforce. And two things, all of a sudden they become producers and they become consumers. And it's a massive explosion in demand because of all the things he said. The baby boomer needs all these things. But they're also coming on to produce. Now, there's a little bit of a delay because they're 20-year-old. I laugh. We say 20-year-olds like that's when entering the workforce. When the baby boomers entered the workforce, they did it about age 15. But okay, that's just different now. People don't enter the workforce until they're 25, 26. So it's an interesting thing to elongate all of the cycles because of this phenomenon that we're just doing. We're staying hidden in institutions and educational systems longer. But anyway, nonetheless, the baby boomers enter the workforce. And although there's a delay because they're not peak producers yet, they're know-nothing 20-year-olds, and they can't produce that much. 10, 20, 30 years later, their skills have exploded and their ability to produce is massively bigger. But nonetheless, they come into the world and they are consumers and producers, and there's this explosion. Now, a theme in history that I notice, and wherever the government has control of anything, is that bureaucrats do too little, too late, right? So eventually, the bureaucrats raise interest rates, right? The question is, was it enough and was it early enough, right? So let's understand what happens as these baby boomers come into the market and demand explodes, right? They're just all of a sudden, they're just like, well, I got to buy all this stuff, right? And they're producing, but it'll catch up soon enough, but not right now. And yes, there's going to be a little bit of inflation, but there's going to be this business productivity. If you're a business owner, it's a great time. The value of the goods you're producing gets bid up. What do you want to do as a business owner? And also, as a new baby boomer entering the market, don't you want to quickly start your own business? So there's this massive increase in demand. And what's the things that are going to happen is existing businesses want to expand their operations and new business owners want to start their operations. Both of those things require them to get business loans. In order for them to get the business loans, there needs to be a pool of savings for them to borrow from. So what happens is the demand starts very, very quickly. Entrepreneurs need to expand their operations and start new operations. They want to get business loans. They need to go to the pool of savings and they want business loans. But the pool of savings is not that much because everyone's spending. That was the increase in demand, right? And so interest rates should shoot up very, very quickly, right? Every day, these entrepreneurs are not upgrading their facilities and expanding their operations is a day they're missing out on this massive exploding market share. So they bid up the price very, very quickly. And the available pool of funds is not that high because we're in this consumption phase of life, which is this baby boomer entering the workforce, right? What happens is interest rates go up very quickly and quite substantially. And this is a huge, giant signal to the marketplace. It's like, hey, stop stop consuming, baby boomers. If you are willing to have a little bit of delayed gratification and put off the purchase of that new sofa, put off the purchase of the new house, put off the purchase of the car and catch the bus to work, if you're able to put it off for a year or two, you will earn 20% on your money. Or something like that. It's huge. It's a huge signal from the market to say one thing, stop consuming. So it reduces the problem on the other end. It says, let's increase our savings, which means that although maybe not net, but it's a deflationary force on the interest rate on the mortgages. Because with the increased savings, now this world is chasing after the business money. The business money that's chasing after the loans has a bigger pool to fish from, so it doesn't push interest rates up as much, right? And then, so you've got these businesses that can expand their operations with their business loans and relatively quickly meet the demand of that is exploding by the boomers, right? And this can all happen very, very quickly. There's a delay. Like the baby boomers enter the workforce and there's this consumption spike. But there's a production spike that happens not too far behind when there's a free market involved. It reacts rather quickly. And to think about how quickly it can happen, think about World War II and how quickly the manufacturing base of America switched to producing war materials. I mean, it happened at blinding pace. And so that's really, really important to understand. But if the bureaucrats do too little too late with regards to interest rates, this demand just massively explodes. There's no incentive to delay your gratification of the purchase and save. It's a reduced incentive anyway. And the pool of savings with which to borrow from for entrepreneurs to expand operations is limited. And if you can get it, you have to pay much higher interest rates because of that fighting over the small capital. And the ability for the production side to expand is massively hindered, right? And so all of these factors weigh in to where for the first decade of that baby boom expansion, the interest rate, the biggest signal in the world, the monetary policy of the monetary system is failing to respond to the market because it's waiting for some bureaucrat in there to pull the lever and say, put interest rates up. And as a result, it's years and years and years behind. And this blows up into a massive, massive problem. And yes, the baby boomers and the expansion of that expanded cohort in terms of volume of number of people in that cohort getting to the workforce is a trigger for it. But it would have been infinitely more manageable had there been no bureaucracies getting in the way of those interest rates. Which ties us into just the puppies and rainbows environment that's going to be when fiat finally collapses and Bitcoin takes over the world as the monetary standard and it's a free floating market rate that we decide. Things are just so much better. Will be so much better. And so I think that's important to point out. That whole situation could have been a lot better had interest rates have been allowed to go up faster and earlier. All right, he makes another point which I disagree with. Let's get to that one.
Is that wages stopped going up. Mm-hmm. So in real terms, obviously, if you add a record number of people, like if you added record immigrants into the US right now, what happens? Wages don't go up.
Right.
And in fact, they never went up again.
Mm-hmm.
In real terms, since 1975, wages haven't gone up. They've gone up 0.3% a year for the median American.
And this is the infamous decoupling from productivity growth, right?
Correct.
Yeah.
Exactly. Because GDP grew because of financialization. I'll come on to that in a minute. But this is where the real crux of the issue starts. So You put all these people in the workforce and like, you compete with each other. So they start.
So here's, again, similar problem. Yeah, you're looking at he's looking at one side of the equation. There's all these people, he's saying they've got this massive demand. They're spenders, but they want to work too, right? And had the businesses have been able to expand their production, there's no point expanding your production. That means hiring people. There would have been a massive hiring of all of these people. And that means the businesses are competing for the wage earners, which means they're going to bid up the wages. But that didn't happen. That would have happened had the businesses had been able to expand. What was required for the businesses to be able to expand? It was allow interest rates to go up quickly and early, soothe the demand time, give businesses a time to retool and expand, and hire people, and it could have happened a lot more smoothly. Okay? Now, another thing that kind of is way off here is he said it hasn't gone up for 50 years. He's completely right. Let's take a moment here and look at this chart. It's like the most important. Okay, so here's the chart between wages and productivity. And this is what Robert Breedlove said, the famous decoupling, right? So once upon a time, trickle-down economics used to work. Like as the worker got more productive, his wages went up. So the red line is wages, and the orange line is productivity. So as productivity goes up, it's a very close correlation between productivity and real wages. And then in 1970s, it completely decouples. And over the course of the next 50 years, there is no more wage growth, despite the fact productivity is going up. Now, what happened in the 70s and the boomers is not responsible for this 50-year trend. That is not the case at all. Again, at the time, it would have been better had businesses had the pool of capital to borrow the money, expand their operations quickly, and bid up the value of the labor, i.e. bid up wages. It would have been better. That didn't happen. That contributed to the problem. But that does not explain this 50-year period. This is elongated so here's the example. If you get a whole bunch of immigrants in a country, of course, that's employees competing for wages. You don't get wages growth. That's not true. That's not true at all. With regards to the immigration situation, we have, if highly skilled people come into the workforce and they can speak the language and can integrate quickly, and they have a similar value system so that a whole bunch of friction is not created in the economy, then you can massively expand an economy very, very quickly, and it's no problem at all. It's just no problem at all. America kind of did this in its famous heyday, the 1800s and even early 1900s, 1700s, all of that. It was a massive explosion, and the quality of life for Americans just rose incredibly. And it's because it was the world's best escaping the tyranny of Europe, looking for freedom. And they came here with a similar mindset, similar value for the most part, mindset, value. They were the most skillful. They had the highest savings overseas that they could afford the trip. So I get that in a time relative, right? I get that there's plenty of people came over with nothing but the clothes on their back. But even to afford the ticket and have the courage put them in a relatively high standing in society. And of course, famously, about 30% of them went back because they couldn't handle it. It was too tough. Under those conditions, you can have a massive influx of immigrants. And it's no problem at all. The country will thrive. It's not the expansion of the population. If you have a massive influx of people and their skills are weak, their language isn't the same, they don't integrate, and they come from a different culture. So, once upon a time, in a very homogenous culture that values this, a man's as good as his word, and you can do a deal on a handshake. There's not much friction to doing business. But when lots of different cultures come in where other cultures don't value that concept of a man's word is his bond, and all of a sudden you have to write contracts and you have to allocate some portion of money to take the person to court to get them to pay, and getting them to pay their debts is a headache. All of this adds friction. So all of those things is what makes in the current environment the immigration a problem, not the number of immigrants. High quality immigrants, that's a very different story. Any country should want as many of those as they possibly can for their own selfish reasons. You may make an argument that for more charitable reasons, you could create a brain drain elsewhere, and you don't want to do that. But selfishly, for anyone else, it's like you have a party, you want all the cool people to show up. It's the same thing. You have a country, you want the highest skilled, best people to show up, and it helps the country. If they have similar values, they understand freedom, they're not going to vote for welfare for themselves, you want many of those people in the country as you can possibly get your hands on. Same thing. The baby boomers were an amazing generation of Americans, and having them enter the economy with all the similar values and the same upbringing and the same ethos, it would have been perfectly fine. It was the intervention of monetary policy that was an initial trigger of the lack of increase of wages. And then, of course, the blindingly obvious one, this is the real reason I wanted to make this video, is the 1971 coming off the gold standard. And that is why, because that whole baby boomer thing, if what Rauol said was true, it might have lasted for a decade, maybe two. It's lasted for 50 years. So it is 100%, it is the government's intervention that has destroyed wages for the average American. It is the decoupling of the gold standard. It is moving to a purely fiat currency, and that is the breaking point. And what another factor, probably the next biggest factor that plays into all of this, I would say, is globalization. You've got letting China into the world, the WTO, the World Trade Organization. And that is effectively because of globalization, because of the efficiencies in transportation, that is somewhat similar to a huge immigrant wave coming in of low-skilled workers. When we allowed China in, when the globalization, what happened was we had a huge glut in unskilled workers. And so their wages in our country didn't rise. Obviously, 1 billion people lifted out of poverty in China because they get skilled, they get taught. Their skills rapidly expand because American entrepreneurism goes over to China and trains up these people for, evil capitalists train them for $2 a day. And, 3 decades later, 1 billion people's lifted out of poverty. So that worked for them. It was extremely hurtful for us. So I just really wanted to point that out. And the reason it's so important is because if you miss properly, let's pretend that's a word. If you inaccurately blame the baby boomers just for existing, for causing this phenomenon, as Robert Breedlove says, the famous decoupling of productivity to wage growth, then you can't solve the problem. And by definition, Bitcoin can't solve the problem of there never being a large, like a baby boomer again. The real problem was the monetary interventions, the bureaucracies not reacting as quickly as the market would have reacted, and Bitcoin does solve that problem. And that's why it's so important that cryptocurrency just take over the world. It's why it's, for many of us in the space, it's like a religion. It's just there's nothing that you could do in the world that would help humanity more than assist cryptocurrency taking over the world. It's the single greatest thing that any human being can do. If you're a teacher, teach people about Bitcoin. If you're a coder, build protocols on top of the cryptocurrency space. Whatever your skill set is, the highest value that you can do for humanity is to work in the cryptocurrency space. And to tie it in a little bit with Ayn Rand, she says, don't do it for charity. The market is telling you do it, because if you work in this space, you're going to get very rich very quickly compared to anywhere else with your given skill set. Do what the market is telling you. You'll help the most amount of people. You're not doing it for charity, but it turns out that's the way you're helping people the most. All right, guys, I hope that was helpful. Let me know in the comments below. Does it make sense? Did I do a good job teaching that and explaining that? Or do you think I'm just wrong? Rauol was right. It was purely demographics. The US government and the Federal Reserve didn't screw it up, or at least it's some combination of the two. Let me know in the comments below. Smash that like button, hit that subscribe button, and we'll see you soon.